Now let's get to see a bigger picture in Europe. European stocks slow down today as the euro climbs and the ECB slices the region's deposit rate by 25 basis points to 2.5% in line with market expectations. Now let's get more from the president of the ECB, Christine Lagarde, as she speaks to the latest rate decision.
The Governing Council today decided to lower the three key ECB interest rates by 25 basis points. In particular, the decision to lower the deposit facility rate, the rate through which we steer the monetary policy stance, is based on our updated assessment of the inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission. The disinflation process is well on track. Inflation has continued to develop broadly as staff expected, and the latest projections closely align with the previous inflation outlook. Staff now see headline inflation averaging 2.3% in 25, 1.9% in 26, and 2% in 27. The upward revision in headline inflation for 25 reflects stronger energy price dynamics. For inflation excluding energy and food, staff project an average of 2.2% in 25, 2% in 26, and 1.9% in 27. Most measures of underlying inflation suggest that inflation will settle at around our 2% medium-term target on a sustained basis. Domestic inflation remains high, mostly because wages and prices in certain sectors are still adjusting to the past inflation surge with a substantial delay. But wage growth is moderating as expected, and profits are partially buffering the impact on inflation. Our monetary policy is becoming meaningfully less restrictive, as our interest rate cuts are making new borrowing less expensive for firms and households, and loan growth is picking up. At the same time, a headwind to the easing of financing conditions comes from past interest rate hikes still transmitting to the stock of credit, and lending remains subdued overall. The economy faces continued challenges, and staff have again marked down their growth projections to 0.9% for 25, 1.2% for 26, and 1.3% for 27. The downward revisions for 25 and 26 reflect lower exports and ongoing weakness in investment, in part originating from high trade policy uncertainty, as well as broader policy uncertainty. Rising real incomes and the gradually fading effects of our past rate hikes remain the key drivers underpinning the expected pickup in demand over time. We are determined to ensure that inflation stabilizes sustainably at our 2% medium-term target. Especially in current conditions of rising uncertainty, we will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. In particular, our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. The decisions taken today are set out in a press release available on our website. And I will now outline in more detail how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. So looking at the economic activity, the euro area economy likely grew modestly in the fourth quarter of 2024. the first 2 months of 25 saw a continuation of many of last year's patterns. Manufacturing is still a drag on growth, even if survey indicators are improving. High uncertainty, both at home and abroad, is holding back investment, and competitiveness challenges are weighing on exports. At the same time, services are resilient. Moreover, rising household incomes and the robust labor market are supporting a gradual pickup in consumption